So for this next one here, I'm going to go into energy storage. I have a couple different classes of storage for this. I'll get into in a little bit, but let's look at the big picture here. You got financial energy that you can store in batteries. So you're going to store this energy that you capture from burning coal or running a hydro plant. You can store it in batteries if you want. Humans, you eat food and then you can work off that energy. You're storing it for later. Maybe a human puts on some fat and they can burn off that fat later, whether it's your glycogen stores or stored fat or whatever. On the flip side, you have financial energy where you can release this financial energy at a later time. Here are the storage asset classes: money, business, and property. And some of you crypto guys are going to kill me for what I'm doing next, but I'll get into all of it later. So physical versus financial energy, just to kind of recap, I'm using the kind of the law of conservation of energy here. I basically say that instead of where physical energy, where it may change forms, with financial energy, it more or less kind of transfers its state from one form to another or one owner to another. So with physical energy, you can store this energy in things like oil, wood, batteries, or even food. Physical energy is released to perform work. And think of physical energy in this analogy as renewable energy, where you are capturing radiation energy from the sun or kinetic energy from a dam. Physical energy put into the equation is significantly less than what you get out of it, the ROI of physical energy. So with the financial energy part of this, I'm saying it can be stored in one of three asset classes. Financial energy is released to perform economic activities like processes. Money are things that you possess that you exchange for other goods. Debt, inflation, and consumption make this a depreciating energy source that must be replenished. Your business is interest-bearing and helps replace financial energy that is consumed. So whereas money, there's a portion of your money section that can be depreciating. Like for instance, you consume beef, you consume bacon, you consume food. But these are also things that you could use to buy goods and services. So there's a subsection of your money category that it has a shelf life to it. Whereas some of your financial energy you want to put into business, that might be like buying a rental unit. It might be buying stocks. It could be putting money into a savings account back in the day when you would get 5% interest, or a CD. So the interest that you get from taking these risks in business are helping you to sustain your daily activities. Lastly, is property is a speculatively owned asset. Now, I'm probably going to catch some flack for this one too, but if you buy a house and you're going to live in it, it's still a speculative asset. If you want to buy a house, you're looking for it. Hey, where's the best neighborhood? What are the best schools? Where's the best location? Is it close to work? You're potentially speculating that your house is going to go up in value in 20 or 30 years, but you might also find from some of the stuff with money I'll talk about below, where you can see the value of your dollar depreciates over the course of a lot of time. So you'll see that in the below slides, and then probably in the next section. But where you're looking at property here is property is also art. It could also be a baseball glove. It could be baseball cards. And unfortunately, I'm putting crypto into this, and I'll get into a lot more of that in other slides. So here are your big three categories: money, business, property. Money, once again, commodities, things that can be exchanged for other things. And I go back to the Wayback Machine with this one. 10,000 years ago, what was money? Now, gold has, as I mentioned in earlier parts, gold has evolved to become a more efficient form of money. And it became a currency. And then at some point in time, you got the paper dollars, which were receipts for the currency. And some cryptos now are receipts for a particular commodity like gold and silver. With your business, there's interest-bearing, which attempt to capture financial energy in the system to grow. Return on investment is commensurate with risk of loss involved. So what you're looking at here is you're taking your stored financial energy and you're choosing to put it into something to grow it, and with that growth becomes risk. So potentially the higher level of risk, the higher level of reward, the lower level of risk, the lower level of reward. So I worked at the Vanguard Group of mutual funds for a better part of 4 years. I was a contractor there, but that was one of the things you noticed, that when you were in your 20s, you may have a much higher risk profile, because if you lose it all, you could all make it all back over the next 30 years. But when you were maybe in your 50s or 60s, you were having a much lower risk profile and you didn't have as much growth. But by that point in time, you had a lot of compound interest that grew your portfolio a lot. So you were looking at, in your later years, to have lower risk. But you would still put this money into potentially dividends bearing equities that would help you on your day-to-day expenses. And lastly here, your property, deeded, owned, speculative assets can be a home, vacant land, or digital property. Value is determined solely by characteristics of property and not intrinsic value. You could say that, okay, my house is 2,900 square feet and the value of it is 300,000, but the value of that is based off of what houses in my neighborhood are and what the last house was bought for. Now, if 16 houses go up for sale on my block, the value of my property will plummet, because the supply locally here just puts a supply glut in my neighborhood and will crush my property values. Likewise, I just saw a $2.2 million house in Laguna Beach that's like 700 square foot, 1 bedroom, 1 bath, and that is a great location. But what you can get into that here is that a lot of this stuff is all based off of how you think the asset will perform and what you think other people will value it at, not necessarily the intrinsic value that you could trade it, immediately for, like, dinner, a sandwich, drinks. So these types of things may be more of a bid system. So think of like art at an auction, or a house with a real estate agent. Even when you're going to sell your crypto, you're selling that on an exchange with a bid and ask. That, if depending on the volume that you have with your crypto, I saw this thing, you could be in a crypto desert where if there's no volume, it can say that your crypto is worth $1, but if no one's buying it, you can have that on sale for days, weeks, months before someone actually buys it, if they do. Maybe you have to lower your price. So property doesn't necessarily have an immediate value. Let's go on further with some money here. So typically used to exchange for daily goods and services. Over the years, this evolved from the barter systems to gold and silver. If you have a freezer full of food, these things are things that you can barter with. It's not very efficient as a medium of exchange, but it's a store of financial energy. Food is perishable and must be replaced. Cash was currency as a medium of exchange that was a receipt for gold and silver, and that is where it had any value as a store of financial energy. Gold is durable, easily malleable into uniform shapes, and thus was the best money. And here I have a little picture of what I considered money over the years. There's some memes going around right now where you have a truck with a bunch of lumber in the back of it, and they talk about a billionaire driving down the highway. So you also see the $20 bill here. For those of you that have not seen this, that are in the financial world, or the common investor that doesn't know anything about this, the $20 bill used to have a little orange seal on it there that basically you could take this $20 bill to a bank, hand it down, slap it down on the counter, and get 1 ounce of gold in return for it. And that was like 100 years ago. And now you're looking at it where 1 ounce of gold is like $1,800. So did gold get that much more valuable, or did the value of the dollar depreciate by that much? And that's the next section I'll go into. Money has utility. And this is one of the things that I run into a war with the crypto people. Now, Michael Saylor will talk about Bitcoin as a crypto asset, and once again, I'll get into that further down, but I'm talking about money as utility, has utility. Now, gold over the years, yes, it was jewelry and displays of wealth. And if you think about it, pharaohs and stuff used to display this. It showed social status. And think about where you're talking about like ancient cultures with India and China. People wear gold and silver to preserve their wealth. But with money, people think of money as units of currency, which is not correct. I like to tell people to think of money from 10,000 years ago and forget that whole concept of fungible. I'm just thinking about what were useful items that people could barter with back in the day. We then later evolved with payment methods and currencies and mediums of exchange to make it more efficient, but money in its purest sense were things of value that were tangible goods. Gresham's law talks about bad money drives out good. And you can see this here. If you start putting fake fiat currency notes that are backed with nothing into your system, people will spend this before they spend real gold that they have in their possession, because they want to exchange this fake stuff that's not backed with anything. They want to get as much good stuff as they can for this stuff that's worth nothing. The dollar is no longer backed by gold for the last 50 years. And you'll see in further slides that it's been printed into oblivion, which increases asset prices. It blows up asset prices. They don't become more valuable. It's that the dollar is getting a lot less value. So what they want to do is they want to drive gold and silver from money and substitute it with unbacked currencies. This artificial energy being added can be observed causing societal issues such as inflation, income disparity, health crises like I'll show that perhaps cancer and heart disease is caused by some of this, and even food supply issues. So with the business class, how do you capture financial energy and increase your storage of wealth here? I'm going to define this as businesses. Think about your local pizza shop. So if your currency collapses tomorrow, you still have ownership in a pizza shop. You can still make the best pizza no matter what currency that you're selling it in. Maybe you're selling it for crypto. In the business class, you have equities as well. Think about shares of large companies, bonds, treasuries, money markets, and even think about your job. You're putting time into your business. Think about time that you're putting into your job to get money back from it. It's an interest-bearing effort. You're putting calories into your body. You're buying food with financial energy, and you're using that stored energy, the physical energy, to then perform work in order to make more money than you're putting into your system. So your business class, you put money into your business class to grow it. The greater the risk, the greater the reward. We mentioned that. A constant of growth for each person can be found with return on investment. As I made mention, like maybe if you're in your 20s, you want to have a higher ROI and you take higher risk. And if you're in your 60s or 70s, you're probably getting lower ROI with lower risk. And this is a big picture of what it is. Your inputs into your business class are these joules of energy. And once you unlock them, your financial energy is used to perform work. And like I mentioned, you use processes, people, technology, and your outputs can be stored as unrealized gains on a balance sheet, dividends, converted to money like gold to use as a medium of exchange, or stored in a financial battery, if you will. Maybe you take profits from your business and you pay off your mortgage. Examples of your business class: investing in your education. That's another one. Choosing the right education and the right ROI. I know this is one of those things where when I was going to college, I wanted to go to University of Pennsylvania. You're going to see a Penn State shirt here. I couldn't even afford Penn State back in the day. So I went to a local private college, which actually cost a lot less. But I didn't have that kind of money. Now today, people are spending $57,000, $60,000, $70,000 for college, maybe for a poetry degree. And what's your return on an investment in that? If you go and get a STEM degree at a local state college, you're probably going to be making more money than the poetry major at an Ivy League college. So think about the business class here. You're putting financial energy into your education. So you want to evaluate your ROI. What are your risks with that? Well, maybe you get into a college, it's well over your head. Investing in your career. When you forego your free time instead of sitting around watching TV, and you want to put that time into your career with getting certifications or higher levels of education, you're improving your ROI. So you're investing in yourself with time. When you want to maybe buy rental houses, be a landlord, you're taking time to then do things outside of your regular career to be a landlord. Investing in stock markets and dividend stocks, investing in a mine to produce minerals. I make mention of this because I like my miners. Also, maybe investing in a condo community with a group of people to rent out units. So these are all types of things that you get the return on investment. And here I'm just making mention of what your ROI is measured as. Basically, your Y is your output. You take your output, you subtract your input, and then you divide it by your input, and you'll get your basic ROI here. So maybe in order to build a mine, you want to make sure that you have a 50% return on investment, so to speak. Lastly, with the property class, maybe an example of this is your lifelong investment in your home. So you're talking about location, location, location. It is speculative based on where the neighborhood and school is. Land, maybe you buy a strip of land thinking that in 20 or 30 years from now, a development's going to come in there and you can sell it for 20 times your cost. I also mentioned your unbacked cryptocurrencies here. And yes, they can potentially be a medium of exchange. And yes, some people are accepting them. But right now, they are wildly speculative assets that are not a legitimate currency. They don't have any intrinsic value. They're not backed by anything, and their values are very relative to trends right now. If you have to worry about somebody creating a meme on Twitter for your speculation to go up, that's not necessarily what I would consider in your business class or money. It's more of a wild speculation. I call it more like investing in beachfront property. So I'm going to get some hate mail for that, but just by strict definition, ask Michael Saylor. He likes to call this property. And it's smart to call it property right now because the IRS is not in your business. So that's a good thing. If you try and call this money and you want to make this legal tender, yeah, you're going to start having all kinds of problem with the SEC. So with your property class, your primary residence, speculative real estate, crypto, can be a long-term storage of financial energy, and your value is determined by location, perceived value, not necessarily utility. And I say that utility because that Laguna Beach house, it provides a great scenery, but it's only like 700 square feet, and I think the cost per square foot was like 2,200 square foot or some ridiculous number. So your utility here isn't necessarily reflective of the cost. New York City apartment buildings are a prime example. Conclusions here: all storage classes have joules which can be measurable. The financial energy is the economy. So I make mention that setting the proper conditions to create a positive ROI makes the economy move. Create opportunities for entrepreneurs. That is the big thing that drives our economy, not stimulus. Now, stimulus in the Keynesian sense helps when you're running into like depression level stuff. I mean, we saw that in the 1930s. It gets things moving. It gets things moving from hand to hand. But in a well-run society, you're looking at creating opportunities where investors and entrepreneurs can then enter markets. And I made mention in the previous one where oil prices were going up. Well, if you can see oil prices are going up and you know that you can get into a business or buy a business and put in your 100 joules and get 200 joules out of it, well, maybe that makes sense for you, and then you get into that business. And then maybe on the other side of that, you create a process that makes you produce it cheaper than everyone else, and you stick around and everyone else fails. Now all of a sudden your company grows because then you can buy other companies and put your processes onto them and make them more efficient as well. So basically growing the economy is not about GDP, it's not about dollars. Growing the economy is about creating opportunity. And when you create the opportunities for businesses to then create a greater ROI and reduce risk, which I'll talk about then a little bit later, basically and I'll talk about that with uh, the rule of law. So if you're going to want to create a jewelry store in downtown whatever city, you want to make sure the rule of law is working for you, so that if you've cleaned up that neighborhood really well, maybe now that creates economic opportunity. It's not about what neighborhood and what socioeconomic background. It's about a lot of things. Like if you're creating an opportunity of location, it's just cheap location because maybe in the past crime was horrible, but now the rule of law is there, crime is down, and it creates an opportunity now that you can get a business in there with cheap rent, and now you can make a lot of money. So laws of nature with regards to physical energy should be applied to financial energy. There's a lot of parallels there that, again, this is not going to be a one for one, but if you I'm going to kind of draw on this a little bit more with like the four economic forces. But if you can unlock the financial energy and spend it, it makes things happen. And part of every single time you unlock financial energy, risk is part of this. It's just the nature of the game. If you can evaluate the risk fairly well, and you have a very good business model with your processes, you can make lots of money. Lastly, this energy can be stored in 3 asset classes. So whatever your output is from your business, you can continue to roll it into your business. Perhaps you take money out of it, pay yourself bonuses, and then you can take that currency and put it into food. You can put it into cattle, futures, whatever it is you want to do with that, or you can, perhaps pay off your mortgage. So with that, I'm going to leave this one off here, and we'll continue with another one. Thanks.